Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Welcome to the Mineral Rights Podcast. Thank you so much for joining us. My name is Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. In this episode, we're going to do a Q&A. So we have some questions that have been submitted by listeners that we're going to cover today. But before we get to today's show, I have a quick reminder. As always, please subscribe to the show on iTunes or wherever you get your podcasts, and please leave us a rating and review. We appreciate the feedback we've gotten so far, and it helps us reach other mineral owners who need to hear this information. To ask us a question to be featured on another upcoming Q&A episode, please leave a comment at mineralrightspodcast.com or send us an email to feedback@mineralrightspodcast.com. With me today is Justin Williams. Hey, Justin.
Good morning, Matt. Thanks for having me.
Thanks for coming on the show, as always. And let's go ahead and get started, Justin. So why don't you go ahead and read the first question that we got?
Sounds good. So our first question we have here is from Butch, and it's kind of a technical question, but a good one. I have a question. I know the production of a fracked natural gas well falls off greatly over the first few years. How long does it take before the well production flattens and stays consistent with very little decrease in daily output? Thanks in advance for your help, Butch.
Okay. Hi, Butch. Thanks for submitting the question. And to answer the question with a generality, I'll just say it depends. And why I say that is because each formation has slightly different characteristics as to how steep the initial decline rate is and what the shape of the curve is. But generally speaking, most unconventional oil and gas wells start out with production fitting what they call a hyperbolic decline. And this is not really important, just to say that the rate changes over time quite significantly. And so this is where you'll see the steep drop in production from month to month, in the first few months. And then after a certain period of time, and again, it just depends on the formation and the basin and the specific well design, even to a certain extent, that the decline rate will actually reach a certain amount that switches over to what they call an exponential decline rate. So basically it's like a straight line if you look at it on a logarithmic plot. And what that means is basically it's at that certain percentage rate. And just as an example, it's 7 or 8% decline rate is what they typically use in the Niobrara formation in the DJ Basin. It'll hit that slope and just that straight line, which is a very gradual decline, and stick to that for, at least the expectation is that it'll stick to that line for the remainder of the life of the well. And again, a lot of these unconventional oil and gas wells are sort of young still. So we're probably about 9 or 10 years into this shale revolution, so to speak. And so we're only really have seen the first third of the life of a lot of these wells, or even less of that potentially if they are going to be more productive, produce 30 to 40 years. So we're not totally sure how those wells are going to behave way out into the very end of their life. But the way that they're being modeled right now, again, is with this terminal decline rate. And again, it depends on the formation. And, you can look and do some searching to find out some papers and kind of estimate what the decline rate might be if you are so inclined. But the big thing here is that it's not going to deviate too much from that in kind of the later years. And how long it takes, that's really just, again, depends on the formation. But just to say that, maybe, a couple of years out before it starts switching over to that terminal decline rate. And so, again, you could have that happen much later, maybe a decade out, or maybe much sooner, just again, depending on where you're at. And again, there's going to be variability. So this is it really depends on where you are within a specific field or basin. And so some of those may have a more shallow decline rate versus a steeper decline rate. And again, it depends on well spacing and how many other wells have been drilled there already. And, it may deter, as we go ahead and drill more wells in a particular area, our assumptions are probably going to have to change, because what will probably happen is that wells will switch over to that exponential decline rate a lot sooner as we drill more and more wells in these unconventional plays. And actually, we have a link we have a link that we'll throw into the show notes of a Wall Street Journal article that actually talked about this that in more detail if you're interested in reading that. So again, it could take off a couple years out, decade out, and it's going to stick there for a significant amount of time, assuming the well is economic. So the other thing, the life of these wells is really determined by what they call the lifting costs, and how much it actually costs to operate the wells, and how much they're producing. And there's a point at which they become uneconomic. It's even though there is the capacity to produce more oil and gas, it doesn't make sense to do so. And so that's when they'll plug and abandon them. And so that's where you'd have to model this to figure out when that would occur based on current assumptions and oil price and gas price and things like that. We do this when we do evaluation for our clients. So if you have minerals and we're trying to estimate what the value is based on the potential, looking at oil and gas production profiles going into the future and cash flow and things like that. That is something we'll model, and this is kind of what we do. So hopefully that helps. And let's go ahead and talk about the next question, unless you have anything to add, Justin.
No, I just was going to say that, from a mineral rights perspective, we would love for it to be something that was very simple and straightforward, but unfortunately it is very unique for each situation. And I know, this is something where, Matt, when you go in and look at this and you're trying to figure this out, it's a combination of looking at the production from that well, looking at the production from wells in that area in the past using the same technology, looking at exactly what technology they're using. There's just lots of details that go into it. But I've been in the same boat, Butch, and it can be very confusing. And we just want a simple answer on a way to try to figure it out. Unfortunately, there's not one. Our next question here is from Crystal, and this is another confusing area that can get interesting. It says, my name is Crystal, and I would love to know the process start to finish on how and when the lease company is supposed to contact the landowner. I would like to know how long I have to respond before I have to say no or choice in the matter. And I would be grateful to know more details in the process of leasing start to finish from the perspective of both the landowner and the leasing agent. What I have found online has left me confused and scratching my head, the exception being the information you've graciously provided. The podcast has given me so much clarity. It has been like a breath of fresh air after suffocating in the unknown game that is the oil and gas lease saga. Nevertheless, as completely new to the game, the landowner with the potential for a lease, there are still gaps in my understanding of this process. I attribute this to the chain of events in my particular situation. Please allow me to give a set of circumstances. Maybe you can offer insight. And she continues to go in here that, long story short, she owns 1 acre. She's trying to figure out whether she should sign a lease, whether she should be force pooled, and kind of what she's trying to do here. And I know this is a really common question for mineral right owners, and it can be very overwhelming.
Yeah, and with 1 acre, it's tricky because the amount of royalties you're actually going to get in the lease bonus amount, it may actually not cover the cost of hiring an attorney to review. So it's a kind of a tricky situation on that space where we typically say you want to hire an attorney and have them negotiate on your behalf, but sometimes it could be more costly than it's worth. The thing that you got to keep in mind too, though, is you got to look at your specific state. And so Crystal is in Louisiana, and so the thing to look there is it's the Louisiana statutes related to statutory pooling, and what are the specific requirements in Louisiana, or if you're in another state, do the same type of search, and you can look for statutory pooling and then the state name and see if there are specific state statutes or regulations that cover this that will outline what the requirements are for both the operator as well as the mineral owner. So that'll help inform, what you should do. But, typically the liability aspect. So she had asked about, what happens if I don't sign, and she calls it becoming a silent partner, or basically becoming a non-consenting mineral owner. She's worried that she'll have some sort of liability with that. The type of liability that you'd have, and we talk about this in a couple of different episodes that I'll refer to here, but I'll just kind of skip ahead and say that, if you were to go be force pooled, you'd have the financial liability, and depending on the state, it'll outline how much that penalty is that they have to recover from the cost of drilling and completing that well. You'll have a minimum royalty that you'll get just by default, which is typically 12.5%. Again, depending on the state, there's different minimum requirements depending on the state and depending on the product. Some of them have different royalties for oil versus gas. But the thing to know is that you would receive a lower royalty until they recover the cost, plus the penalty amount. Usually it's like 200 or 300% of the cost of that drilling that well. Once they've recovered that, then you get back the full undivided interest in that spacing unit. So you wouldn't get 100% of all the oil and gas, from that well, but your proportional interest in that. But that could be a long time, or it could be, that they never actually recoup that amount. So in the meantime, again, look up the information on what statutory pooling requirements are. We have an episode that covers this in a lot more detail on episode 8 of the Mineral Rights Podcast on forced pooling. So listen to that, and you can go to our website to find out more information. But I'm going to just step back and say that, from the things that she's mentioned in the email, the kind of the full email about what she's done after she was contacted by a landman and she hired an attorney or has talked to an attorney, and they have a form of a lease that has been accepted by that operator in the past. And so it sounds like she's doing all the right things. And again, Crystal, your attorney should be able to advise on specific timing that you have to when you receive notice to when you have to respond or you're forced pooled. And one of the things that you've done is, gotten a lease that is looked to be pretty good terms. I think their initial offer was for 3-year primary term, $1,000 an acre, and 1/5 royalty. And that's not a bad. Honestly, certainly the royalty rate is good. Primary term just being 3 years is good. I can't speak to the lease bonus amount. I don't know what the going rate is in your specific area, but for anybody that does get in Crystal's situation and needs to find out more information about what's the going rate for a lease, I would recommend going to the Mineral Rights Forum and go to the state and county, and they have a group for that county. And if there's enough activity level, people will be posting on there what kind of royalty rates they're getting, lease bonus amounts, the term of the lease, and all that good stuff. And you can find out how your lease offer compares to that, and then use that information to help negotiate the best deal possible. So something to think about if you're in Crystal's situation, go to Mineral Rights Forum, again, hire an attorney. But the big thing is, definitely do your homework, take your time in negotiating, but keep in mind what the statutory requirements are for when you have to respond before you get forced pulled. You don't want to drag your feet too long, because then you'll just end up getting forced pulled. And in terms of whether it's better to lease or be forced pulled, it just really depends, I guess, on the specific circumstances. But in general, I would typically steer somebody to try to negotiate a lease. And, usually if there's one company that is negotiating with you or is making you an offer, there's others out there that would be interested. So if you don't receive an offer that you're happy with one lessee, then I would shop it around and contact some of the other operators in the area and tell them that you've received a lease offer. You're interested in seeing if if they want to make you an offer. And then usually when you have lease that comes up and your minerals are in an area where there's a lot of development, you'll start to get multiple offers anyway. But if you just have one coming in and it's you feel it's too low, then you can go out and try to get a better offer out there. Again, we have 3 episodes kind of on this topic. One of them's on leasing, which is episode 6, which covers this in a lot more detail. Episode 7, talk about working interest for mineral owners. So this is if you receive that pooling notice, and usually it'll have in there, what your choices are. And one of those could be to participate in the well, which, means paying your share of the drilling and completions cost for a working interest. So we covered that in a ton more detail in episode 7. Again, if you a forced pooling situation, episode 8. So a lot more out there. You can do some more research there. And the thing to keep in mind too, I will say about financial liabilities, we talked about already if you got force pulled. But if you do end up trying to negotiate a lease and you're worried about the lease bonus amount, think about the royalty rate and how that's going to impact the value of your property should you go to sell ever. So, for example, if you were just wanting to get the highest lease bonus and you're willing to accept a 12.5% royalty rate, a well gets drilled and you're held by production, that lease is going to be in effect for a really long time. You go to sell it, a mineral buyer is going to only pay you one half of what they would be willing to pay for that same tract if it were leased at 25%. So you basically have cut the value of that property in half if you accept a subpar royalty rate, assuming you're going to, again, it doesn't expire, you don't renegotiate it. But if this is held by production and it's going to be in effect for a long time, your royalties are proportional to the royalty rate, right? So think about that seriously before you sign the lease. So hope that helps, and good luck.
Yeah, great job, Crystal. And like Matt said, I think you've done a great job of handling this. And in my experience, best thing you can do is have a trusted advisor to talk to that has your back and that you can trust with what they have to say. This is something that constantly changes, and each area is unique. So having somebody, an attorney especially, to work with is a wonderful thing. All right, our last question here is from Tom. Great podcast. I found out about your podcast when you hosted for Mark LaCour. I have 2 leases in production in Uinta Basin. And my question is, once your lease is in production, can a new operator change a lease agreement from the original operator? And that's an interesting question. I have never heard of that one happening, Matt, but the properties change hands so much. I would imagine it does.
Yeah, properties change hands quite a bit. And when that happens, you'll see a lease assignment. So the previous lessee will assign that lease to the new lessee. So, an example, let's say operator A has the original lease with the landowner. They decide to get out of that basin and they sell that asset to another operator, operator B. They'll record a lease assignment and it'll list all of the leases that are part of that assignment. And so you can look at that at your county clerk and recorder's office if you do hear wind of one operator buying some wells in one area from another, and maybe that operator that you had a lease with, you can check and see if your lease is covered by that. The thing that you got to keep in mind though is the terms of the lease won't change. So the thing that I'm not an attorney and I'm not really qualified to give you legal advice. So definitely, if you have run into an issue with this, consult an attorney licensed in the jurisdiction where you own the minerals to help, and they can help navigate that. And contact the operator on your behalf if you run into an issue. But like I said, in general, when a lease is assigned from one party to another, the terms of the lease do not change, whether it's still within the primary term or if it's held by production. They may ask you to ratify the lease and to make sure that you still are being held by that. So if they are wanting to confirm your concurrence to that lease, they'll may ask you to ratify it. But again, if you run into an issue with a particular operator and there's some discrepancy between what you agreed to in the lease and what they're saying, it could just be that there's an error made with when they transferred your account to the new operator and when they input that information into their accounting system. And so if you're having a copy of that lease is really helpful to where you can contact the owner relations department, send them a copy of the lease, state what you feel is the issue. And then, when you do start getting checks or division order from a new operator, maybe that's purchased well that you have an interest in, that's always a really good time to check your royalty check, your first couple of royalty checks, to make sure that they haven't made a mistake. They're not taking deductions that they shouldn't be. Royalty rate is correct. The net revenue interest is correct. And so that's something that's always a really good thing to do, and do kind of a mini royalty audit at that point. If you want to understand how to calculate your net revenue interest, we cover that in Mineral Rights Podcast episode 3. And so you can go back and listen to that episode. We talked through a couple examples there. Anyway, I hope this helps, Tom. And for everyone, we have a few other mineral rights Q&A episodes, or one other episode that we did that was part of the first Friday Q&A on oil and gas this week. So if you look at OGGN or oil and gas this week on iTunes, you can find that podcast. We sort of took over the show for an episode and answered some mineral rights questions. So there's a few other questions we've answered out there. If you're interested in going to give that a listen, that's a great show as well to stay on top of the overall trends in the industry and what's happening with oil prices and geopolitical stuff. That's a great show to subscribe to and listen to as well.
Absolutely. And that was a blast taking over for them. And it's a great way to learn things as well as a mineral right owner, because just in talking about it and listening to them discuss different things going on, it's easy to learn more about it and pick up. And some great questions for everybody. And we thank you so much for sending those in. And we look forward to having more.
Absolutely. And that's all we have for this episode. And again, if you have questions you'd like answered, email them to feedback@mineralrightspodcast.com. Subscribe on iTunes or wherever you get your podcasts. And we will talk to you next time. Thanks again.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.